Hello, good evening, everyone. Welcome back. Welcome back. I'm Mia James, your favorite financial wellness coach, and we are going over week five, or chapter five, I should say, in What the Rockefellers Do. I missed you all last week. I was in Honolulu, and with the time difference, it was just a little like we were out and about. And now that I use Zoom to do the lives, I really need to be stationary. It's not as easy to do it like on a phone and then also have the book because I use a Kindle. So here we are. We are back, and we're finishing out chapter five. So if you are here with me live tonight, let me know in the chat. Now again, I use a different software, so like it's multiple screens. I use Zoom now to go live. So there's like multiple screens for the chat and then the book and all of that. So let me know where you are joining me from, and I would like to just say hello to you. So with that being said, we are going to jump in and let me just see where we were. Hopefully. Hey Errol, good to see you. Great session last night. That was amazing as always. So if you have the book, we are again on wrapping up chapter five of the book, What Would the Rockefellers Do? And I'm just going to go back in my Kindle here. All right. So in the Kindle, I will tell you that we're on page like 67. Um, so we stopped somewhere around there. And of course, if anyone has any questions about anything we discussed previously, because I know it's been 2 weeks, please feel free to drop them in the chat. Hey, Junior, good to see you again. Also, glad to have you here. Oh, Global Woman Business. Okay, is that you, Gisela? Hi, sis. I like that. I did not know that was your YouTube name. Awesome. Okay, so we are jumping right on in on page 67. And let's see, where should we start today? I think we might have done 67. Let me double check. Okay, yep, we sure did. Okay, so let's go to the next page then. Okay, here we are. Okay. So what basically to kind of recap where we were from last time, what the author was doing is comparing, how people have different types of policies, or excuse me, different types of vehicles that they borrow from. So, you might have your retirement plan, like your 401k, 403b, 457, things of that nature. He also talked about having municipal bonds and the pros and cons of those. And comparing different interest rates, like your interest rate on if you go to a loan to a bank to get a loan versus using your whole life insurance or your life insurance to be your own bank, right? And so this is completely legitimate, but what you might hear on social media and Instagram and all that kind of stuff, people are talking about being your own bank, and in the same breath they're like, oh yeah, we can get you a life insurance policy for $20 a month. That is not optimally funded, and that is not going to produce the results that he is sharing with you in this book. So, um, still on page 67, we'll start here where he talked about retirement plans work if you borrow from them, but he's like, there's no guarantee of principal without moving your money to a money market at a lower interest rate, nor is there necessarily a death benefit. So, for example, I've had clients who borrowed money from a 401k, but because they quit that job or they were laid off or something like that, they didn't have the opportunity to pay that money back and still have that money working for them in that account, right? And so, when we think about our retirement plans, if you withdraw the money, right, you may not either be able to pay it back depending on if you still work there or not, or if you withdraw the money and depending on, what the market is doing, if it's not necessarily growing, you don't necessarily leave behind a guaranteed death benefit for your heirs. So, what he is emphasizing in this book is really, even if you use your life insurance policy, to do various things, and I'm going to get into that here in a second, you still have the option, you still have a death benefit and some type of inheritance left over, even if you do use some of the funds. So, and if you do take a loan from your life insurance policy, here's the great thing. You can actually put back extra. Now you have to be strategic about how and when you do that. Hey, Doriel, good to see you. Does anybody know why it's important to be strategic when you put money back into a life insurance policy? Let me know in the chat. I want to know if y'all know this because there is a strategy to putting money back in your life insurance policy, and there's a reason for that. You can't just go putting in whatever you want. You do have to be strategic about it. Does anybody know why? Let me know in the chat. What do you think? And this is a judgment-free zone because I want us to learn and some of us already know a lot of this stuff. So let me know. Does anybody know why? Well, I will tell you just in case. You probably already know, but um, what life insurance has, so this is written in the IRS code, more appreciation. So it actually has to do with taxes, believe it or not. So in the IRS tax code, permanent life insurance policies have special treatment. And the IRS actually allows you to put in a certain amount into your policy every year and maintain the tax benefits of that life insurance policy. Well, what are the tax benefits? I'm kind of going off on a tangent, but I want you to understand it because what he's talking about borrowing money. So I want y'all to understand what happens when you borrow money. Okay. So if you take it's called a modified endowment contract. So you never want your life insurance policy to become a modified endowment contract. It's MEC for short, MEC. And basically, if it becomes a MEC, you lose the tax privileges. Well, Mia, what are the tax privileges? Well, you can withdraw money from your life insurance policy tax free, and then the death benefit can go to your beneficiaries tax free, right? So who doesn't want tax free money? However, if your life insurance, if you put in too much money, right? Remember, there's a ceiling because, Uncle Sam want his money. If you try to put in too much, your now tax advantage life insurance policy becomes a MEC, modified endowment contract. I'm going to put that here in the chat so you have it. This is what you do not want, okay? You do not want a modified endowment contract because you lose your tax privileges. So again, if you borrow from your life insurance policy, just remember that you always want to call your carrier. And if I'm your life insurance agent, I call with you because, I have a lot of clients who want to put more in than their monthly payment because they want to see their cash value grow faster, right? So that's why it's important to know what your limit is, your threshold, and then don't go above that. Now, the carriers that I work with, they don't even allow you to put in more money than your cap. So any questions about that? Because since we're talking about the beauty of being able to borrow from yourself and being your own bank, I want to make sure that you all understand the implications of that. So if you have questions, just go ahead and drop them in the chat. I'll be checking over here on my right. So one thing he talks about, again, I'm on page 67 in the Kindle. He talks about with whole life insurance, it offers guaranteed returns and powerful tax advantages and significant liquidity. Now, again, with the liquidity piece is not going to be as liquid as like your savings account. I do have to be transparent with that because you have to build up the cash value. And in some instances that can take time unless you put a lump sum in. So, if the interest rates go up or down, your principal is safe within the policy because you have when you have your cash value and your dividends have been paid. So with whole life policies, they pay dividends. That's how your cash value grows. If you have another type of permanent policy like an IUL, it tracks an index. So it's not in the market, right? So it's not volatile. It's not going up and down with the market, but depending on how the index performs, your cash value can grow. Okay. So thanks 416 Favor for your contribution. Um, so essentially, in many instances with certain life insurance policies, you can have a guaranteed minimum interest. Oh, I have a question. Yay. So this is Drain D. Ryan Bale. Okay. How long before you can withdraw once you build cash value? Great question. That is a wonderful question. Okay, so and I know you're probably not gonna like my answer. So it depends, right? Because if the cash value is available, then you have access to it. Your when you go get your statement, there's usually an annual statement, but obviously, you don't have to wait until your anniversary. You can actually see how much cash value you have access to. And then at that point, you can either choose to take a loan or you could take a withdrawal. So, Dr. Ian, thank you. Okay, I appreciate it, Dr. Ian. Yes, you knew what I needed because I'm old school. I'm like hooked on phonics. So, oh, duh, DR, doctor. Excuse me. And then Global Women Business says, what about a GUL, Guarantee Universal Life? So, the GULs that I've designed, I'm sorry, y'all. I'm getting over some kind of weird allergy stuff. The GULs that I've designed, um, or more like permanent term policies. So I have not, and I like to be transparent with y'all. I have not designed guaranteed universal life policies that actually grow cash value. And now you got me curious to see if there are any others out there. So the ones I've designed are, so basically, if you all know, like term policies, they last 10, 20, 30 years, right? And then if you would like to keep it, the price goes up based on your current age and health at the time. With a GUL, it's more affordable than most permanent policies because it'll last your whole life, but it's not going to grow the cash value. So it's not as it does, the premiums that you will put in are not as high as say a whole life or IUL, which is Index Universal Life. So great question, Gisela. I like these questions. Keep them coming. This makes my life so fun. Okay. So but now you have me very curious to see if there are any GULs, because I work with 80 different carriers. So, as opportunities present themselves, what I'll do is go do research and I'll see if there are any GULs that do offer some cash value. I just have not trained on them just yet. So, one thing that he talks about, he says if interest rates go up or down, your principal is safe with whole life because when you have your cash value and your dividends have been paid, you're guaranteed a minimum interest rate. So that's one of the guarantees of whole life. And that means you don't have capital depreciation. And so instead, this gives you stability and predictability. And this is important, especially if you're a business owner. Um, okay, thank you. I think we do work with Securian Life. I have to look into them. I haven't worked with them yet. So let's keep on going here. Let's see. What I highlighted a lot of stuff, y'all, in the book. So um I'm not gonna go through every single thing I highlighted, just the main things. So basically, when it comes to life insurance, I'm just curious. Okay, so I'm gonna name one, two, three, and four. So he talks about four categories when it comes to insurance. And so when you hear your category, put that number in the chat for me. Okay, category number one. And this is, he says people tend to fall into four categories when it comes to insurance. So category one, you hate it and you avoid buying it whenever possible. So if that's you, put a one in the chat. Number two, they hate it but begrudgingly buy the minimum amount. So if you're like, I hate it, but I know I need to have it, so I'm going to get the least amount possible, put a two in the chat. Number three, they like it but don't use it properly. So maybe you have it, but you're not maximizing it. Okay, so that's three. Or four, you understand it, you love it, and you use it to its full potential. So let me know in the chat, where are you? Are you one, you hate it and avoid it? Number two, you hate it, but you have the minimum. Three, you like it, but you don't use it properly. Or maybe you like it, but you haven't explored it. Or four, you understand that you love it and you use it to its full potential. So let me know in the chat where you all are. Or if it's something else, you could put in something else. Okay, awesome, Dr. Ian. Thank you so much. So we got to get you using it properly. That is so key. Um, so one thing that the author likes to do, and I'm terrible with authors, his name is Michael Isom. He says, for an entrepreneur, and let me know if there's any entrepreneurs in the chat. If just put entrepreneur in the chat if you're an entrepreneur, because I want to know who, I know some of you are entrepreneurs, but I have some new folks here tonight. He says, for an entrepreneur, an optimally funded whole life policy is most effective when used as an opportunity fund or even a war chest. And I know I read it a couple pages back, but he talks about a war chest. Let me get the definition for you all because I've slept since I read it. Okay. He says a war chest is money that you can use for any surprise that money can help you solve. So that's what a war chest is. Money that you can use for any surprise that money can help you solve. So if you have like a catastrophic health incident, right? Or you need to have long-term care or um an opportunity that you can't refuse comes up and you need money fairly quickly. If you have cash value, then you can go ahead and use that. I've had clients use cash value for real estate opportunities. Um, I've used it to fund my business. So there's definitely ways that entrepreneurs can use this. And if you are an entrepreneur and you've kind of maxed out your SEP IRA or your self-directed IRA or anything like that, you can also potentially use this as tax-free retirement because a lot of people we're taught, let's just say, from my experience, I don't want to put that on you all, but from my experience, a lot of people are like max out 401k because they want to get the tax advantages now, not realizing that later on, one, you could be in a higher tax bracket, and two, you may not want to reduce your living standards. Like I know Errol, for example, he likes to live, right? And so I don't necessarily think like somebody like him is trying to reduce expenses in retirement because you want to enjoy life a little bit more. So if you're still withdrawing 100, 150, $200,000 a year on money that hasn't been taxed, well, when you go to withdraw that money, you might, if you go to withdraw 100K, you might end up with 70K, depending on what the tax rate is at that time. So that's really important to understand tax diversification. And I know that's not what this class is about, but I do like for people to understand that you can leverage your policies to potentially have tax-free retirement income. Okay. Ooh, sorry. 8:20. Okay, so let me highlight some of the ways that Michael has used his whole life policy. He's used it to pay off loans, he's used it to finance businesses, he's used it to do hard money loans, secure inventory at a discount. Because I don't know, I didn't see anybody put entrepreneur in the chat, but I know there's some entrepreneurs in here. Y'all might be multitasking. He's used it to make down payments on real estate and even buy out real estate partners. So this is really actually a lovely opportunity. Of course, the main objective is the death benefit, but there's so much more you can do. And I feel like a lot of people that I'm around really don't even know that they have this opportunity at their fingertips. And especially for people who don't, may you can still be in the market. Like I'm in the market and I also have this. But for some people who don't want to be in the market because, some people are risk averse, this is a great way for you to build your wealth and not be directly in the market. So there's a lot of opportunities. Okay. So I'm going to share an example with y'all. So what I'll do now is share my screen, and I'm going to show it to you in the book because some of you may not have the book. So I just want you to see this, and then we're going to wrap up. He's talking about, this is page 70 in the book, in the Kindle version. He's talking about how his clients are leveraging their whole life policies to fund auto loans. So one thing that, a lot of times you might go to a bank or a credit union or the car dealer and request a loan, right? And what his son was doing it at the time, and his son did a comparison between the interest rate from the life insurance policy and the interest rate from the car dealership or the bank, excuse me. And obviously, well, I shouldn't say obviously, in this particular instance, the the life insurance interest rate was lower than what they were charging at the bank. So obviously, they went ahead and took the $20,000 out of the cash value. But what he did, okay, you all should be able to see it now. So this is I'm right here on this page where he explains how they leveraged it. So he started his child's policy when he was young. So he had been putting in $350 a month for over 20 years. So that kind of shows you that you got to put some money into it. Like people come to me and are like, I have $50 a month. I was like, well, you're not gonna like the numbers. I was like, we can get you some coverage, but if you're trying to do this, you want to put some skin in the game, right? And his son was probably a kid, which is why 350, excuse me, was sufficient. And he ended up having 130,000 in cash value. So he took a $20,000 loan, and the loan rate was 5%. So to skip ahead, because I know we're running out of time, but I want to make sure you all understand some of the ways that you can use it. So he went to banks and credit unions, and he was quoted a 7.5 to 8% interest rate. So obviously, he went on ahead with the life insurance loan. So in the event that you do take a loan from your policy, your cash value is your collateral. So who remembers in the chat how much cash value did I say he had after his parents had been paying in $350 for 20 years? Anybody remember how much cash value he had? It's over 100K. No, I think everybody is multitasking. Okay. So it is 130,000. So he was able to use that as collateral to qualify for the loan, right? And qualifying for a loan from your policy is not like going to a bank. It's like just filling out some paperwork. Because if you don't pay the loan back, that's fine. You don't have to. It just will reduce your death benefit. But it's in your best interest to pay it back because obviously it'll help your policy grow. But look, this is the important thing. His cash in his policy continues to grow uninterrupted because the insurance company is assuming, excuse me, that you're going to pay it back. So your balance is still going to be the same as if you never took the loan. I mean, you'll obviously see it on your statement. There we go, Dr. Ein. Yes, 130,000. Yes. So, um, so what his son did, which I think was super smart, even though the life insurance only required 5% interest, he actually paid 7.5% interest back to himself, meaning back to the life insurance policy. Now, you have to make sure that this is doable based on how much premium you're already paying and what your premium is allowed for in a year's time. Right. And so this all has to do with the design. And I'm not going to go into that because that's like advanced. But he was basically giving himself a 2.5% bonus. So he was paying back, however much monthly he agreed to pay back on the $20,000 plus 7.5% interest. But he only had to pay five. So he was giving himself a 2.5% boost. I mean, if that's not genius, I don't know what is, right? So he's keeping this 2.5% for himself. Um, and so he goes over here. He was saying that, um, oh, this is a completely different example. One second. This is another example. I don't know why it's not doing right. Okay. It is not doing what I wanted to do. I'm gonna drop this in the chat for y'all. If you want to look at the numbers, like let's just say you're just curious about doing this for an auto loan, I'm going to put this link here for you all if you want to explore. Oops, take that period out though, so that the link will work. But it's just rockefellersbooks.com/auto. So you can look at the numbers. Let's just say you already have a policy. The key thing here that I want to leave you with before we get off is this part here. If your policy is designed well, remember I talked about design. A lot of times, some people will come and say, I want the cheapest thing possible, right? Remember, you get what you pay for. So, um, you know, people will come back and they'll say, well, why didn't I have that much cash value? Well, you didn't put that much into it because you wanted the cheapest thing possible. That goes into the optimally funded part. If you don't fund it, you don't get those nice numbers, right? And you have to build enough cash value. So some people, not only do they pay their premium, they also you could start a policy with a lump sum. So if you have 10 grand, 20 grand, 30 grand just kind of laying around in a regular savings account making 0.01% interest, you can put that money into your policy. And a lot of policies on average, minimally, are going to get you a guaranteed rate of 4.5%. Like my policy nets about 9% a year. So I'm like, yeah, I'm not having my money just chilling in the savings account. And it's so funny because people are always like, oh yeah, just send me X amount of money. I was like, I don't just keep a lot of money just sitting in accounts that don't pay interest or significant amount of interest. Like even my checking account pays interest. So I'm very mindful about where my money is, if it's especially if it's sitting, that is actually making money, even if it is sitting for safety purposes, like emergency fund. Like it has to be doing something. Um, so the main thing I want to leave you with, if you are, thinking about funding one of these policies, this is the key. The design, right? There's a way to design it where you can maximize the cash value. You have to fund it. $50 a month is not going to cut it. Like you're not going to be happy with it. Um, and you have to allow it time to build cash value. So it's not an overnight thing unless you put in a significant lump sum. And he's saying that if you want to be able to take out a loan right away, like within the first year, more than likely, which he's not saying directly, you do need to put in some type of lump sum so that you are already go into the policy with cash value. So that's really important to understand. Because a lot of people don't tell you that. They're like, they think, okay, I started it, now I can pull money out. It doesn't work that way unless you put in a significant amount of premium. So that's chapter 5 in a nutshell. I do recommend you read it because there are some illustrations on here. Um, This is very small. Like it is too small. I can't even read this. And I tried to blow it up before we even started, and it would not come to a size that's even legible. So, what I'll do for next time is I'm going to run an illustration. I have to see how I can do it because I can't share companies, but I'm gonna see how I can do it for you all where I can show you numbers. And if anyone wants me to run an illustration for them, you can definitely reach out. You all have I'm gonna put my number in the chat. This is my 855 number. You can just text me and we can set up some time so I can, get the information for you and I can show you what your numbers would be. and design something like this for you. But I definitely this would kind of show you, you know, what you can expect cash value wise. So, and for those of you who are not in the chat, the number you can use is 855-718-2018. Just send your name and a message, and I'll send you a link to set up a consultation, and we can, you know, kind of see what options are available for you. Life insurance, just in a nutshell, is based on age and health. Like that determines what your premium is, which is the payment, and you know how much you qualify for. So you do have to qualify. But if you don't qualify because of health reasons and you have a lump sum, there's another type of product that you can have access to, um, which has some other benefits. All right. Well, with that, I'm gonna stop sharing. If there's Does anyone have any questions before we leave tonight? Thank you all for coming, and thank you for participating in the chat. That always makes me so happy. All right, I don't see any questions, but I hope you all have a wonderful night. Go ahead and read ahead to chapter 6 so you could come with questions for next week. And I look forward to seeing you then. Same time, same place. Until then.